Welcome to the second question clip on Chapter 10. We are going to be dealing with the question on DVDs for Africa that you can follow in your question book as well as in your suggested solutions. And remember to pause the video if you do not understand something and you can look at it again. We're going to read the required part of 10.20. In the A part of the required, they ask us to prepare the general journal entries which are necessary to record the adjustments mentioned above in the books of DVDs for Africa on 30 April 20.9. So we are at the end of our financial year and we want to finalize, before we can get to the closing process, our adjustments. In the B part, show the disclosure of the current assets section in the Statement of Financial Position and the necessary notes of DVDs for Africa, again on 30 April 20.9. We are just going to do the current assets section and the necessary notes to explain the amounts in the current assets section. We get our framework sorted out for the general journal. We need a column for our debits and a column for our credits. Please also use a page for your calculations so that you can route the marker to the marks so that they can award all the necessary marks. Then we're going to start reading the question. DVDs for Africa is a retailer that purchases DVD players wholesale and then sells them individually. The periodic inventory system is in use. Periodic inventory system, remember, we do not keep track of inventory in the inventory account, but we use alternative accounts. And we also do not use a cost of sales account in the periodic inventory system. They also mentioned that a constant gross profit margin of 30% on the selling price is maintained. So although we do not use this percentage after each sales transaction, it might be necessary for certain amounts that's provided that you have to convert. So let's quickly get our 9 blocks for this question sorted out. Cost price, profit, selling price. If they tell me that it's a percentage on selling price, then the selling price will be the 100%. The profit then 30%. So the cost price percentage-wise will be 70%. So we're going to apply this if it becomes necessary. Some adjustments and corrections still have to be made at year end, and the following balances and totals amongst others were taken from the books of DVDs for Africa on 30 April 20.9. So this is right at the end of the year when we're doing the adjustment process as well. They provided us with the following totals and balances. Shop equipment at cost price with accumulated appreciation on the shop equipment, but the date for the accumulated appreciation is the 1st of May 20.8. So that's the start of the year. They have not yet performed adjustments, so the depreciation has not been recorded yet. Debtors control and the allowance for credit losses, and then they give me cardboard boxes on hand on the 1st of May 20.8. Now again, this is the start of the year. So that implies that they did not do the reversal of the opening balances from the asset account to the expense account. So we'll have to deal with that. The stationery on hand, however, can you see there's no date at the end? That means that this stationery on hand is on the 30th of April 20.9. So it's not the same time frame as the cardboard boxes on hand. Then we've got an unfavorable bank balance. Unfavorable bank balances will not be included under current assets, but they will be included under current liabilities. Then we have our expense for credit losses, our interest expense, and our cardboard boxes expense for the year. So that was the balance in the cardboard boxes account at the start, and this account was used for any purchases of cardboard boxes. Now in additional information number 1. Cardboard boxes are used in the repackaging of DVD players, and a physical stock taking on the 30th of April 20.9, this is now the end of the year, revealed that cardboard boxes to the value of 870 Rand were still on hand. Then they carry on, while the cost price of the DVD players on hand amounted to 13,800. So let's first deal with the cardboard boxes. You'll recall we had cardboard boxes on hand on the 1st of May 20.8. That is the start of the year. So we will first have to do the reversal of this asset out of the asset into the expense account. Remember, in practice, you will first use the cardboard boxes that you had on hand at the start of the year before you start purchasing new cardboard boxes. So I would want to move this asset to the expense to indicate the consumption of the cardboard boxes. So for that reason, to remove an asset, we're going to credit the asset account. So we're going to credit the cardboard boxes. On hand. That's the asset account that we're going to credit, removing it from the asset, and we're going to debit the expense account, which is the cardboard boxes expense. So at the start of the year, that balance was 620. I'm just going to leave out the journal narrations to simplify the explanation. Remember, unless they tell you that you can ignore journal narrations, you'll have to include them in the answer. Okay, at this point, if we look at our expense account, we had a cardboard boxes expense of 2,400. So that's how they accounted for it during the year, 2,400. We just moved the cardboard boxes on hand at the start of the year also to the expense account. So at this point, we are actually saying our cardboard boxes consumed, because that's the expense account, adds up to 3,020. Now they performed a physical stock take, and they say the cardboard boxes to the value of 870 Rand were still on hand. Now, if these cardboard boxes are still on hand, that means I have not yet consumed it. So it cannot be included in the expense. So I will have to credit the expense account with the 870 Rand and move that to the cardboard boxes asset account. Because the asset represents something under your control that you can still use in the future. So for this journal entry, we're going to credit the cardboard boxes expense and debit the asset account. So I'm going to debit my cardboard boxes on hand, which is the asset account. I still have that asset to use in the future, and I'm going to credit my expense account. With the 870 Rand. They also mention that the cost price of the DVD players on hand amounted to 13,800 Rand. Now, we are in the business of buying and selling DVD players. So this is our stock take of our inventory at the end of the year. And because we are applying the periodic inventory system, we did not keep track of inventory in the inventory account. So the only way that we can get to a value for inventory will be by performing this physical stock take. So I now need to account for the closing value of the inventory at the end of the year. Now you will recall that in the trading account, we calculate cost of sales using our formula opening inventory plus purchases minus the closing inventory. So this entry for the closing inventory will have to influence the trading account. If we counted the inventory, that means that our asset is valid, so our asset will have to be entered on the debit side. So we're going to debit the inventory account. You only account for inventory in the inventory account at the end of the year when you're applying the periodic inventory system. and we're going to credit our trading account. And the value that was provided is the 13,800, which is the result of the physical stock take. So now we dealt with additional information number 1 on cardboard boxes and the inventory on hand. In number 2, stationery to the value of 1,620 was consumed during the year. There was no stationery on hand at the beginning of the year. So they opted for accounting for stationery purchased in the stationery on hand account during the year. Remember, you can either put it in the expense account or in the asset account when you buy it, and that will determine the direction of your adjustment at the end of the year. If they tell me that the stationery on hand, that means during the year that was available for consumption, 1,730. Of that, only 1,620 was consumed. In my asset account, I accounted for 1,730. But an asset is a resource under your control due to an event in the past that will lead to an inflow of benefits. So I can't say at the end of the year, if I've consumed 1,620, that my asset is still worth 1,730. So I will have to take out the consumed stationery. For every credit, I need a corresponding debit. And that will be in my expense account, resulting in this account in a balance of the stationery that I can still use in the future. So we have to account for the consumption out of the asset into the expense account. I'm going to have to debit my stationery. And stationery, just like that, implies its expense. And then I'm going to credit my stationery on hand. With the consumption of 1,620. This differs from the cardboard boxes, where we move the cardboard boxes on hand from the expense to the asset. Here we're moving from the asset to the expense, and that's why we use the consumption in number 2. Adjustment number 3. Debt to Nobucks debt had been outstanding for a long time. A payment of 540, which represents 30 cents in the rand, was received and recorded during April. So we've already recorded for the 540. At year end, the owner decided to write off Nobucks' remaining debt. If the debt of a debtor can be seen as 100%. Now they mention that 540 rand, which was 30 cents in the rand, so that is 30% of the total, was received and dealt with accordingly. The balance, 100 minus the 30, so 70% of the debt must now still be written off. Now, if we can do this calculation, I'm not provided with the 100, so I cannot use 100% in my calculation. I'm looking for the balance, so I want to get to 70 out of, they provided me with the 30 times the 540 rand. So if we do our calculation, remember not to be tempted by that percentage button, because we cannot use the 100. So it's 70 divided by 30 times the 540, and that will give me 1,260 rand. We have to write off the amount because we're never going to get it back. So let's earn marks for the 1,260. I am going to debit my expense account called credit losses. I incurred this loss because of the credit that I granted in the past, and the credit entry will be debtors control for the general ledger / the name of the debtor for the debtors ledger. And the amount that we calculated, 1,260 Rand. Number 4, during the year, the owner took a DVD player with a selling price of 3,000 Rand home for personal use. He did not pay for it. The following entry was made for the transaction. Now, I'm glad that the entry is not here, because what I want you to do is first visualize what the entry was supposed to look like. If the owner withdrew, the owner can either be influencing his capital or his drawings account. Now he took this home for personal use, so we're going to debit the drawings. That's visualizing what it was supposed to look like. Debit the drawings and credit, remember it's the periodic inventory system. Periodic, we cannot use the inventory account, so we're going to credit the purchases. And in the purchases account, we never work with the selling price of the goods. We work with the cost price. So they provided us with a selling price of 3,000 Rand. We now have to convert that selling price to a cost price using our 9 blocks at the top. So we are looking for a cost price, which is 70, divided by a selling price, which was 100, times the 3,000 Rand. And that will give us a cost price of 2,100 Rand. So we wanted a debit in drawings of 2,100 and a credit in purchases of 2,100 Rand. If we can now look at what they actually accounted for, they've got a debit in debtors control of 3,000. We want a debit in drawings of 2,100. So that entry is completely wrong. I don't even want to influence my debtors at all. So to correct a debit in debtors control of 3,000, I will have to credit the debtors control with the 3,000. Then they have a credit in inventory of 3,000. We mentioned it's the periodic inventory system, so that complete transaction is also incorrect. So to get rid of a credit in inventory, I have to debit the inventory account. With 3,000. Now I've reversed the incorrect entry, debit the inventory and credit the creditors control. And I can go over to what I decided this transaction must be accounted for at debit in drawings and a credit in purchases. And the value calculated as 2,100. Additional information number 5. A debt of 2,000 of debtor Blue Boy was written off during the previous financial year after he passed away. During the current financial year, however, a payment of 15 cents in the rand was received from his deceased estate, of which no entry had been made. 15 cents in the rand means that for every 1 rand in there, we received 15 cents. So we can just take the 2,000 rand and multiply it with 15%. R2,000. And that gives us the 300 rand that we received now after we've already written it off. So this is like a brand new little profit that you made. You receive the money in bank. So we debit our bank account. And the name for this little profit is credit losses recovered. Remember, you've already taken this amount out of your debtors, so you cannot influence debtors if you recover the credit losses. This is a profit after the fact. 300 rand in bank and 300 rand in credit losses. Additional information number 6. The majority of the sales are on credit. And because the credit policy was not applied strictly, it unfortunately resulted in many debtors' accounts being written off. After careful consideration of the age analysis of the debtors, management decided that the allowance for credit losses must be adjusted to 16,396. Now, if we have to adjust it to a different amount, we first need to determine what is the current value of the allowance for credit losses. And in my trial balance, the allowance for credit losses currently is standing on 13,164. And I want to turn that into 16,396. So 16,396, that's what I want it to be, but I already have 13,164. So my adjustment is to the value of 3,232. I want to increase the allowance for credit losses, and an allowance for credit losses is a contra asset on the credit side, so I will have to credit the allowance for credit losses. Remember, this allowance is created to adjust the value of your debtors. That will come in the B part of the question. So we're going to credit the allowance and debit the credit losses. So in your credit losses account at this point, you're going to have your actual credit losses that you've written off during the year, plus this adjustment to the allowance for credit losses. Because I want the total expense incurred. Remember, incurred is accrual concept. So it's the actual credit losses written off plus the allowance for credit losses. And the adjustment that we make, we calculated it as 3,232. Additional information number 7. Depreciation on shop equipment should be provided at 25% on the diminishing balance method for the current financial year. And now they mention new shop equipment as well. So as soon as we read about depreciation, write down your formula for the method, and it's diminishing balance method. So that means we're going to have to deduct the accumulated depreciation from the cost price before we can multiply with this percentage and an amount of months. So we're going to use this not only for the old equipment, but also for the new shop equipment. So we're going to have to split this calculation into old and new. They mention that the new shop equipment of 30,000 was purchased on the 1st of December, so they already give us information regarding the cost price, 30,000. This transaction has already been recorded. So if we want to get to the old cost price, we'll have to take into consideration that this 30,000 is already included in the cost price of the shop equipment. That's a total. So to get to the old equipment's cost price, I have to take the total of 120,000 and deduct from that the 30,000 for the new equipment. That will only represent the cost price of the old equipment, that calculation. So let's continue with the new equipment. I purchased 30,000. They tell me that the depreciation rate is 25%, so I can multiply that with 25%. There's no deduction of accumulated depreciation because a new asset cannot have any usage in my entity yet, so there's no deduction there. And then I have to count from the 1st of December to the end of my financial year, which is 30 April, and that will give me 5 months. So if we take the 30,000 Rand times 25% for 5 months, that will give me 3,125. That's for the new equipment or the new shop equipment. For the old equipment, I've already calculated the cost price, but now I still have to deduct the accumulated appreciation from this cost price. And the accumulated appreciation on shop equipment provided on the 1st of May, 47,680. So only at this point have I included the cost price minus the accumulated appreciation. I have to multiply that with 25%, and the old equipment I had for the whole year. So if we do that calculation, first complete your brackets. 120,000 minus the 30,000. That is my cost price of the old equipment. Then I deduct my accumulated appreciation. So now I'm at the end of that bracket. And then I can multiply it with 25%. So that gives me depreciation of 10,580. This calculation, if we add up those two amounts, I can now account for the 13,705 to earn the marks. This is on shop equipment, so I debit my depreciation. And I credit the accumulated depreciation. On shop equipment. Calculation of the old and the new added together, 13,705. Okay, they mention that in number 8, all the other shop equipment was purchased at the beginning of a financial year and there's no residual value on the shop equipment. We included in the calculation this information already because there was no residual value deducted from the shop equipment, and we didn't do the apportionment per month for any purchase during a financial year. So that has already been taken into account. Okay, so we've now accounted for all the adjustments in our general journal. And then in the B part of the required, we have to show disclosure of the current assets section. Now the current assets are those assets that you will be using within the next 12 months. And in this question, we had two of the current asset elements. And the two elements will be the inventory account and the trade receivables. Trade receivables and inventory can include a number of items. Inventory will be the goods that I buy with the purpose to sell it, and that we will call merchandise in our note. And any other items, consumables that we might have had on hand at the end of the year. So note number 3 for inventory will include the merchandise, the inventory that I buy with the purpose to sell it again. And in this case, we made an adjustment to the physical stock take at the end of the year of the inventory to the value of 13,800. So we can include the 13,800 as our merchandise. Our cardboard boxes on hand was also counted, and it was stated in additional information number 1 that the cardboard boxes on hand to the value of 870 Rand were still on hand. So I can include my cardboard boxes on hand of 870. And then I also had stationery on hand. But the stationery on hand was not given as a value. They tell me that the stationery to the value of 1,620 was consumed. I know that I bought 1,730 during the year, so my stationery on hand I will have to calculate as my purchases minus the consumption of 1,620, and that will give me my stationery on hand at the end of the year of 110 Rand. 13,800 plus the 870 plus the 1,110 will give me my total inventory of 14,780, and that will be on the face of the statement of financial position, included merchandise and all my consumables on hand. Then for trade receivables, this is an important value for analysis of financial statements. So under trade receivables, I will only include the receivables because of trade. So that starting point will be my debtors. And the debtors was given in the trial balance as 86,240, but we had a number of adjustments influencing my debtors. If you have a look at your adjustments that you prepared, you need to determine when I had any adjustments to debtors. There we had a credit in debtors control, so that will have to be deducted. Here we had a correction of an error, again a credit in debtors. And if we have a look, that seems like all the adjustments. So we're going to have to deduct those two credits from debtors control to add up to my debtors control. From this debtors, this is an asset, remember, and we want a true reflection of the amounts receivable. From past experience, we know not all of the debtors will come to pay us. That's why we create an allowance for credit losses, and we adjusted the allowance for credit losses to 16,396. So that will be deducted from my debtors. There's another allowance that might also occur in other questions, and that is the allowance for settlement discount granted. If you need to make an adjustment at the end of the year for possible settlement discount due to your credit policy, that allowance will also be deducted from trade receivables. In this case, it's not applicable, so we can calculate our trade debtors. 81 minus the 16. And that is the amount that we can include in our trade receivables face of the statement of financial position. And that concludes the current assets section of the statement of financial position. I hope that this will assist with your understanding of adjustments and extracts from the financial statements. Good luck.